Welcome, everybody, to Navigating the Minefield, where we talk about everything from precious metals through to base metals, even crypto and the macro space. And as always, it's a great welcome to Eric. How's it going?
It's going well, Roger. How are you today?
Very good, very good. It's a hot space at the moment. There's a lot going on. So before we do kick off with that, I'm just going to remind everybody that none of what you hear today is going to be investment advice. This is all for entertainment and engagement purposes only. Do your own research, work out what your goals are, and invest accordingly. But things are starting to move. Silver on the move, copper at all-time highs, and obviously we've had gold back at 2,400. So the whole space has really caught a nice bit on the underlying commodity side.
Yeah, it's one of those things where I've seen this over and over and over and over in my career. Skeptics, trolls, they can point early to when, if I've been bullish a bit early and talking about when I saw action coming and that is delayed, it actually had been. They focus on that or they leave, they just lose interest. But the fact is that we've been talking about now for weeks that there's evidence from the marketplace itself that are triggering some of these internal convictions that I've had for several months that, we're finally at a point where a bull market is unequivocally here in metals and mining stocks. So what does that mean for your viewer? Doing right now is critical. The seed planting, if you believe that this sector is just starting to get going, you've got to be deploying capital. That's been my main message to my people at the Gold Investment Letter for months, but really, especially in the last few weeks. I had a heart-to-heart with my elite and premium members 2 weeks ago, and I just said, listen, if there's anything I can tell you, it's you need to be putting money to work in these areas, regardless of whatever trauma you've got from the last 3.5 years or recency bias. Reset yourself, slap yourself in the face when you're shaving and brushing your teeth tomorrow, because it's a different environment. We just walked into a bull market. And the reason I got in this sector in the first place is because you can make a lot of money in a bull sector. If you're involved early and you are positioned well and you don't chase things, but you're there and you're ready for when this time kicks in. Because gold, silver, a lot of these metals, they tend to move pretty fast. I mean, if you look at the price of gold or silver on the breakouts over the course of the last decade, you're talking about a condensed period of a few months when they end up ripping. And that's why I've been saying that once we had closed through that 2,100 on a monthly, we're going to 26, 2,700 at a minimum to 3,200. And it's going to likely happen within 18 months of that occurrence. And we're well on our way now.
And are you licking your chops, as it were, the move in silver? Because we had that big consolidation for a few years, and now $30, $31. It's broken out of that, and now we're looking back at sort of 2013 levels. But obviously, silver is one of these ones where everyone's been wanting it to break because that's the high octane play. Is that something that you're excited too?
Yeah, I'm starting to pivot to being a bit more focused on isolating silver miners, because we've talked about this. Silver is like gold's wild, poor cousin. It's like wherever gold is headed, silver tends to follow that trend, and it's juiced up, meaning goes lower in percentage terms on the downside, which we saw in the bear market, and it goes higher in percentage terms on the upside. So, and that actually kicks in more and more as the bull cycle matures or the bear market, silver gets whacked a lot harder. And my whole viewpoint has always been, well, is it an industrial metal or a monetary metal? Well, it's just like with everybody in the markets. When something is dead cold, it's an industrial metal. It's not going anywhere. It's not even a precious metal. Doesn't matter anyway. It's all about economic activity and supply and demand. When it's hot, when gold is hot and people are looking for places to store money to capture that monetary store of value or get ahead on it, in the second half of a bull cycle, I think that people start talking and putting silver in a monetary box much more often. So you just have to anticipate the way that people are looking at this. And now the other thing you look at is that the silver mining stocks, there's way less options than on the gold side, whether it's exploration or production companies or whatever it is. To get pure plays in silver is pretty tough. I think we're going to get to a point, and this is like not investment advice nor wise investment advice, it's a comment, but if you have silver in the name of your company and you're a junior miner, if and when we get into a phase 3 mania bubble phase, which we're far away from, by the way, your stock will explode for no reason. It'll just be people are hunting feverishly to get exposure to silver stocks, and there are not as many options as there are in gold. So the upside is obviously bigger. The options are less, so the upside is bigger and the downside is bigger. The volatility is bigger than gold, but I'm super jazzed about silver. I've been focused on accumulating, positions in the physical metal for years. The tough part with silver, when you buy physical, I mean, you buy 500 ounces in an American Eagle box, it's 42 pounds. So, even at $30 silver, you're talking about 15, 16 grand worth of silver for 42 pounds. That's quite a bit to lug around. So the physical part is a bit tougher. You can buy, obviously, like SLV, broad exposure to the larger and mid-cap silver miners. SIL is sort of like the GDX, GDXJ on the gold side. But me, I mean, I love our individual silver stocks. We're starting to see Silver Corp, which we highlighted not long ago. That's challenging, if not already today, might even be in the new high territories. Yep, brand new highs in Silver Corp SVM, and also brand new highs yesterday for the year in Silver Storm SVRS, which is the Canadian symbol. So the two that we highlighted there, one very small, one is a producer, mid-cap, they're popping.
Of course, there is nothing better than decent price action to get everyone interested. But it's interesting, isn't it, that with copper, which has been moving up for quite a while now, but now that it's actually made, at least on the COMEX anyway, and I think maybe on LME too, made these new highs, suddenly there's a lot of that talk about the potential sort of 10, 20-year disparity between the needs for sustainability and all that sort of stuff and the actual availability of copper in the ground. And sort of you're hearing that long-term story again. Plus, there's evidence that China's been stockpiling copper, which it may be holding on to try and grab share in the electric vehicle market. But, it's kind of broadening out, isn't it? The point is, we talked about gold, it was all gold, and then now got silver, copper as well. They're all kind of there or thereabouts. So it's not just a precious metal story. This is actually an extraction metals mining story.
I think so. And there are a lot of people that don't ever correlate gold movement in terms of what that means for the precious metals in general. But I tend to have seen over the years, especially with cycle changes, whether it's a powerful cyclical rally or secular, gold leading the way, silver tagging along, and then all of a sudden we start to see the commodities in general wake up. There was a short squeeze going on in New York in copper this last week, and it seems to have really shaken up the markets. I'm looking at something from the 16th, the end of last week on mining.com. Copper short squeeze in New York is rocking metals markets. We're at $5 copper. We're at $5 copper, guys. This is not something where this is, the companies that have been in production, that have been gobbling up assets, that have just been dead in the mud, trying to survive for years and years and years, if not decades. I mean, this is where you want to have some seeds planted. And there's also a lot of commentary about people that are just unable to deliver on the metal already, with some of this stuff. So people are scrambling for supply. And I think this is just a very, very, very small blip in terms of signs to come over what could be many years of shortages. Wait till we see what happens with nickel. Nickel's already back almost to $9, or I think it is at $9. Yeah, we're back at $9.61 on nickel. So some of the projects that, I've got big positions in that need like $9, $10, $11 nickel to be economic, that are trading at like, 2% of NPV at 5%, which is incredible. And these are large, massive, massive projects. They're going to start kicking into gear. And this is where you get tons and tons of leverage. And the nickel producers and the copper producers, boy, oh boy, are they going to have a field day if we even go higher from here and there's any sustainability for that. So I'm really excited for broad, metals. I mean, you could start to dig into titanium and zinc and iron ore and all that stuff. That's not really my focus, nor is it my main interest. I only have interest in things like zinc and titanium as byproducts. Like, there's a lot of titanium, iron ore, vanadium connections. And, I'm big in vanadium as what I think will be the king industrial battery metal of the future. There are real opportunities in some of these niche metals, critical metals, and then you have your broad ones. And I think, for me, I don't have an edge in iron ore. I don't, even in copper, it's clear to me that we've got some shortages that are going to be popping this market and giving it tailwinds on the upside. And that's why we own things like, I know we've talked on this channel even back in 2020 about like McEwen Mining, and I had focused at that time about their San Andreas, their copper asset, which is number 8 or 9 in the world in terms of undeveloped copper asset size. They've been working feverishly on that with massive partners, Rio Tinto, Stellantis, fourth largest automaker in the world. I had put money into McEwen Copper in a private placement about 2.5 years ago at $10 a share. I believe it was under 300 million was the actual post money valuation. And Rob McEwen had led that round. It was an $80 million round. He put in 40. This is US dollars. And then rounded up by guys like it was $250,000 minimum. And then, there were very few individual high net worth investors, but there were many institutions. And then there have been 2 subsequent rounds. And the last one was 800 million for a valuation led by Rio Tinto and Stellantis again for access to the copper asset, which McEwen Mining, that is the public vehicle that has all of their gold assets. We had an interview with Rob recently on the channel. And at the end of, I believe it was the second interview, I said, Rob, am I out of my mind? But I look at where you had valued in the private market from some of the biggest mining companies and automotive companies in the world. Your interest, McEwen Mining's interest as a shareholder in McEwen Copper, is trading at par with your market cap of McEwen Mining. That means you can buy into, and now I think it's gone up a bit from there. It's just bounced off of a big pullback. I think it's actually very interesting to take a look at around $11 US again, because Rob McEwen's put in $230 million and his cost average is over $21 a share as one bullet point. But you can essentially add, and I think there's going to be another big event on McEwen Copper, whether they spin that out or there's another big raise. That's a massive project. It's now coming into winter in Argentina, so they're going to slow down their feverish pace of drilling, catch their breath. But then if that's an IPO on its own, it's going to be $1 billion plus, in my opinion. And then so you look at McEwen Mining, you can buy into McEwen Copper, which is a massive play, and then get the gold assets, which are producing, 130 to 160,000 ounces of gold per year profitably, and all of the various, exploration and JV and option agreements that they've got around Nevada and some of these other projects. There's still some real opportunities if you're shrewd out there to get exposure to copper, to get exposure to nickel, and to get exposure to gold and silver on the cheap. But you've got to be looking right now. That's my main message today is, if anything, guys, just be aware, be looking, be awake, and be looking to deploy capital. You don't have to listen to me. You don't have to listen to any particular ideas out there. Just, do your own homework, get busy, because now is when you're going to find the steals. All of a sudden, this stuff on the low end of the market, it's just going to reset. And when it resets, good luck trying to get a good position.
We've seen these big moves in the metals, but so far we've seen only small relative moves in those miners, even when I look at the big stuff. So when I look at the European, it's the basic resources sector, but it's largely miners. It's called the SXPP, Eurostock 600 Metals and Mining, it's basic resources. It's still lagging the copper price by quite some way. When I look at the Aussie dollar, which if there's volume coming out at these sorts of prices, the Aussie dollar would normally do well. Well, the Aussie dollar is lagging the move in copper. The point being is that we still haven't seen many of the related assets move in a commensurate way. So they're still lagging these prices that we're seeing in the underlying commodities, which in some ways suggests there's still potentially quite a lot of opportunity out there, as you say, if people do their own work and do it now. the barn door has not been wafting open, the horse hasn't bolted and been closed behind it. The horse is still in the barn for many of these stocks.
In the barn are like, starting to creep their head out. And a couple of them have left the barn. The bigger ones, look at like, Agnico Eagle, one of the leaders, new highs every week, new highs, and these things are not overtly overbought. Newmont, Barrick, these are the type of names where you want to watch those leaders to see where they're headed, to see where the rest of the sector is going to go and what's going to trickle down there. But, I think things are also changing a little bit, Roger, in the sense that the Aussie dollar is not just going to trade tick for tick with copper. You're not going to see the Canadian dollar completely firm up, just as we're seeing with the metals prices. And even if oil goes up, and that country also is a very big beneficiary of natural resources, and that sector is a big chunk of the economy. But we're also dealing in a world now where you've got debt that is out of control versus GDP in virtually every nation, including in America, certainly in America. And you've got to be careful about what you're really pricing these things in going forward. Are you going to look at, yes, you have to look at your own currency. That's why gold is always, and it has always been to me, it's an inverse mirror of your fiat value. That's the one where you can see it. If you've got an extra weak fiat currency, you're going to see an extra high gold price in that currency. And that's a way to protect yourself. But when you start to look at the commodities, there's a lot of pressure that's going to come into these nations with regard to the cost increases that are out there in terms of like, how is their GDP growth, or are they going to be going into recession and things of that nature when there's pressure on the consumers and on the corporations with some of these price increases.
Also, what it reflects in terms of that Aussie dollar relationship is it also reflects part of what you're saying, which is Chinese debts are so big and creaky now that China's no longer doing that growth at any cost, which was just hoovering in all commodities, regardless of the price. Yes, they stockpiled some copper, but China is not that growth at any cost model that was behind a lot of these correlated moves between currencies and commodities. So they're no longer in that game in the same way because they're one of the key countries which has to deal with a very, very bloated system, just like a lot of the other places in the world, which is why the underlying commodities themselves look very, very attractive. And eventually, yes, the stocks will catch up. But I think, as you said a few weeks ago, what we've been seeing rather than out and out M&A, you've been seeing a lot of companies taking stakes, but more interestingly, a lot of real world companies that need the copper, like Stellantis, taking stakes, almost kind of missing out on the sort of the middleman and just going, well, we're going to go straight into these. And I think those will build over time, and eventually, maybe in 12 months' time, the true M&A will probably come through as the big boys start to reap in the cash rewards of the investments that they've done, and then they'll go on that acquisition spree in the future. Those small guys will get taken out in the next sort of 12 or 24 months off that cycle.
Yeah, and maybe it'll be a little longer for some, but I think that, the one thing I want to talk about really quickly that I've been saying now for probably about less than 2 years, but I've been stressing that the folks that own the metals in the ground are going to be the kings of the future, and resources in the ground, kings of the future. What do I mean by that? Look what we're seeing on, say, even the correlation with the AI side of things, with data centers and the energy grid and the energy that we're going to need for all of this compute power. A lot of this, we're dealing with Sam Altman just has got his new nuclear fission deal. Microsoft building their own nuclear facilities. They're all going downstream. And I think you're going to see more of that when it comes to, like, let's just say, for example, on the lithium ion battery side, you have many of those that have tons of nickel. In most iterations of the lithium ion battery have a lot of nickel, cobalt, graphite. There's a lot of those different factors that are out there. So I love some of these specialty metal pieces. Then you've got, when people start to wake up to vanadium on the industrial side. And this is a metal that's a small market that the Chinese and the Russians have a complete grip on. The price is very low right now because I don't think China has an interest in it being higher. They've got all this inventory, as you said, on like the real estate side. They're not going to be needing all this stuff for stainless steel, but they are putting the US and Canada and even the Europeans in a very interesting spot because they control it's not a critical metal per se, I don't believe, but vanadium, to me, it's insane that Canada produces less than 0.01% of the world's vanadium and has a ton of it. The United States is around 1%, and we have a bunch of it. Phenom Resources, biggest asset in North America, highest grade, furthest along, up for a $200 and $300 million grant from the U.S. Some of this stuff applies to next generation rocket technology. And to secure our own energy supply chain, these smaller companies that have been doing this heavy lifting in a rough market, man, if they make it through here, and then we start getting, whether it's government support or just capital that's going to say we need to develop this stuff in North America, there's some huge opportunities in stuff like that because we're just way behind the eight ball. It's actually dangerous.
Anecdotally, on your point, and I saw it on Twitter, so it must be true, but it was something like one ChatGPT search takes 10 times more energy than a Google search. So the new technology just requires, you said, so much more energy there for the networks, etc. And one last thing before we sort of sign off for the day. Do you think that, given some of the data in the US has been softer, are you encouraged by the fact that we've seen these breakouts in the metals when actually people could be arguing that the slowdown is now coming? Now, I'm not saying recession is coming or anything like that, but do you think that the sort of price action that we've seen during some of these weaker data points is indicative of a sector that not so much recession proof, but actually might ride a recession better than we'd normally expect this high beta sector to ride through a recessionary type period?
Yeah, I mean, I don't want to say it's irrelevant at all, because if we go into a hard recession here, projects get halted, copper will be affected. We also don't know exactly where copper is going to settle out after this squeeze. Does it settle? But anything above $4 copper, there's going to be a lot of activity in that area. And you're seeing more and more studies and companies that are coming out and saying, right around just over yonder, there is a massive shortfall of supply of these commodities like copper and nickel and many, many others. And that doesn't assume some sort of a booming economy. That could be in a flat economy or mild growth. If we have a severe recession, yes, there's going to be some buying opportunities is what I would look at them as, because I'm telling you, the feeling I have out there in the marketplace is that people just don't understand how far behind the eight ball we are on catching up with what's going to be needed to, essentially build out our infrastructure. Energy problems are a big, big problem. We're already seeing these rolling blackouts and things. California has a lot of issues. There's issues in different parts of the world. And, we need infrastructure. And for that infrastructure, we need to see production higher in many of these materials. And, a recession, I don't want to be blinded to the fact, we're in like this kind of Goldilocks boom period right now. A recession will happen, but I don't know that it's going to impact these particular metals as much, because it's not just like this correlation to stainless steel or, to construction anymore. There are many other things that are driving demand that are growing exceptionally fast, faster than anything we've ever seen before.
We'll maybe have a look at some of the sort of longer term sticky thesis in next week's show, where we can have a deeper dive into this space, because this space is now obviously fanning out into a much bigger play than it was when we kicked off at the back end of last year. So thanks again, Eric, and I'll catch up with you next week.
Appreciate it, Roger. Have a good day.